The stock market is nearing all-time highs again despite high interest rates and ongoing uncertainty about tariffs and trade policy. Will the market continue to climb this wall of worry? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update. The date today is June 20th, 2025, and today we'll be discussing what we believe to be the main factors driving the stock and bond markets today and going forward. My name is Paul Latta, and I'll be doing most of the speaking today along with some assistance from our intern, Mercy Datta, who's joining us from MIT this summer. My business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin today with a discussion about the recent market action, stocks, bonds, and other assets. Then we'll look at the macroeconomy to add some support behind the market discussion. Then we'll move to a microeconomic view and look at key industry-specific drivers. Then we'll conclude with some longer-term observations about the investment landscape. The S&P 500 is up 2.3% on a year-to-date basis through June 18th, as shown on the left, but there has been much volatility along the way. First quarter was rather a bruising experience, with the market pulling back just over 10% and officially entering a correction as investors wrestled with rising trade tensions and fears of stagflation. But the second quarter saw retail investors flood into the market and buy the dip, pushing the market back to positive territory and near all-time highs. The chart on the right shows the S&P 500 is up 108.3% over the last 5 years, and that the pullback in the first quarter was somewhat meaningful but not long-lasting. The bond market is up 2.9% year-to-date, as shown on the left. It seems the bond market has been in a trading range most of the year with little movement from the Fed on possible rate changes. Over the last 5 years, bonds are down 4.4%, as shown on the right. The bond market is still below its 2020 highs when central banks around the world cut rates to near zero amid the COVID pandemic. One of the bigger headlines emanating from the bond market in the second quarter was that Moody's cut the rating of U.S. Treasury bonds from its top AAA rating down one notch to an AA1 rating. Moody's concern was the decline in fiscal metrics. As we can see here from the Congressional Budget Office, projections for U.S. debt levels are a steady upward slope. While there may be some timeliness to the downgrade, and amid discussions on spending related to the so-called One Beautiful Bill Act, the move by Moody's follows similar moves by Fitch in 2023 and by S&P in 2011. At the Fed meeting earlier this week, Jay Powell reiterated his stance to hold rates steady and that 2 rate cuts are most likely in the balance of 2025. These two charts show similar outlooks for the Fed rate cuts over the balance of the year, with the chart on the left being an investor consensus based on Fed funds futures, the chart on the right being the median projection amongst economists. Bottom line is that the Fed seems likely to proceed very cautiously with rate cuts, given the possible inflationary impulse resulting from the sharp rise in tariffs, as well as the history of secondary waves of inflation experienced back in the 1970s. Most global central banks have been cutting rates since inflation peaked in 2022, but there are variations in timing and levels. The Fed started cutting rates last September, but then froze amid new and sizable tariffs. The European Central Bank, meanwhile, continued to cut rates amid falling inflation and to reduce headwinds to growth. Japan, in contrast, is the only G7 central bank that has actually been raising rates, though from a fairly low level. Let's return to the stock market and the key factors driving investment there, as shown here. We've already discussed interest rates, but let's look at some of these other factors too. Where's the stock market headed from here? This slide looks at the main bullish and bearish points in the point and counterpoint fashion. Right at the top of the list is tariff policy changes. Bears are clearly concerned that the new tariffs may be inflationary and that the uncertainty around new tariffs is causing businesses to freeze spending and growth plans and creating a recession risk. Bulls would not disagree, but would point out that since the tariffs were announced, nearly all tariff adjustments have been lower tariffs, not higher tariffs. The trend of lower tariff announcements is good news for investors and a tailwind that not dissipate anytime soon. Fed policy is also on the list. Bulls are convinced that Fed rate cuts are in the offing and that rates will normalize well below where they are today. Bears would not disagree with the direction of lower rates, but would disagree on where rates normalize. Higher for longer is the fear of bears. Bulls highlight that despite fears over tariff policy, the economy continues as resilient as ever, with strong labor market, rising consumer spending, and most services growing. Bears would point out that not all is well, as consumer sentiment is near a 75-year low, corporate earnings have been fairly patchy at best, and manufacturing is in modest contraction. On valuation, bulls would note that the stock market is about fairly valued, with the earnings yield of the S&P 500 about in line with the yield on the 10-year Treasury. But bears would say valuations are actually near all-time highs when measured on a simple PE basis. Lastly, bulls would highlight the capital formation associated with America's innovation engine, with advances in AI, robotaxis, gene editing, and more. Bears would contrast that with the increased geopolitical risks upon us, with hot wars now in Ukraine, Gaza, and Iran. The balance of 2025 does not have a uniform consensus. The remainder of the year is likely to experience volatility along the way. The style factor breakdown year-to-date has been interesting, yet unsurprising, as the first quarter was dominated by defensive styles like low volatility, value, and income. However, the second quarter was precisely the opposite, with performance dominated by the more aggressive styles like high beta, momentum, and growth. In a way, this is about what one might expect when the market was weak in the first quarter and strong in the second quarter. Still, it is somehow comforting to see that the universe is acting as it should. Investment returns in 2025 by sector so far show an eclectic mix, with industrials leading the pack. That's partly related to tariff policy, especially for aerospace companies. Utilities are closely behind industrials, not for the usual reason that utilities outperform with rate cuts or recession fears, but instead for the merchant power companies that are still benefiting from the regulatory change that restricted access to peak generation assets. Consumer discretionary was the weakest sector, though that mainly reflected softness at Tesla amid a variety of challenges there, ranging from weak sales to controversy over Elon Musk's affiliation with Doge. This is a chart of the S&P 500 over the last 10 years, as shown in blue, and then we have the valuation of the S&P 500 using the price-to-earnings ratio in purple. As you can see, the S&P 500 has done quite well over the last decade, lifting an impressive 238.8%. The present price-to-earnings ratio, however, is fairly high, sitting here at 21.5 times right now, which is above the middle of the range of 14 times to 24 times. This is one of our favorite charts. It compares the earnings yield on the S&P 500 to the yield on the benchmark 10-year Treasury bond. Whichever line is higher, in theory, is the better value. As you can see, stock and bond valuations have converged substantially. Also note that if you look close at just 2025 on the far right-hand side, you can see the market dip in the first quarter manifest as a spike in the red line. And since the higher the line, the better the value, this chart suggested the first quarter sell-off in stocks was a buying opportunity, and especially relative to bonds. Here we can see the market breadth in recent decades, viewed here by simply measuring what portion of the S&P 500 stocks outperformed the overall S&P 500 index. Note that 2023 and 2024 were two of the narrowest markets in history, with just a handful of large stocks responsible for the bulk of the move in the overall S&P 500. The big movers were, of course, the Magnificent Seven, which included Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. Most of the remaining 493 stocks in the S&P 500, well, most of them underperformed. From the perspective of an active investment manager, an extremely narrow market effectively shrinks the dartboard, a challenging environment. In the first quarter of 2025, many of the Magnificent Seven names began to reverse. The effect has been a substantial broadening of the market back to more normal levels, or even above normal levels. In the second quarter, the market breadth actually pulled back from its first quarter peak, but still held above the 50% level. So the dartboard is back to normal size, not oversized, but just normal sized. While the S&P 500 bounced back in the second quarter, the U.S. market is actually one of the worst markets in the world in 2025 so far. The U.S. is up a mere 2.2% year-to-date through when the table was priced here on June 13th. China is up 19%, Europe is up 26%, and even Mexico is up over 30%, as you can see here in the right-hand column. Why is the U.S. so weak? Capital is clearly flowing out of the U.S. markets and into foreign markets. The atrocious relative performance of the U.S. market reflects a handful of factors, as you can see listed here. A reversal of the U.S. exceptionalism of 2023 and 2024, the Gen AI theme losing steam after 2 years of huge gains, the new and isolationist trade policies pushing capital away from the U.S., and the weakening U.S. dollar that is strengthening non-U.S. markets when measured in weaker U.S. dollars. While the bulk of the strength outside the U.S. was actually manufactured here in the U.S. by trade policy and technology consolidation, there were other factors in various non-U.S. markets that also clearly played a role. Europe's dovish central bank, for example, was able to take advantage of sub-2% inflation with more rate cuts. Latin America bourses were lifted partly because of being so deeply oversold in the last year. And South Korea popped with the newly elected president. We touched on the weakness of the US dollar on the prior slide, but these charts give a snapshot visual of the weakness. On the left is the US trade-weighted dollar index, which has dropped to a 3-year low. On the right is a 3-year chart of just the euro exchange rate versus the US dollar. Note that the euro is the biggest component of the US trade-weighted dollar index. While the dollar hit a 3-year low, the lows are actually just below the lows of the normal trading range, and so not really a headline maker so much as an alert that further declines from here will indeed make the headlines. Same story with the euro hitting a 3-year high. We'll chat more about this later in the slideshow. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin by looking at GDP levels by country. In the column on the far right, you can see that most developed economies are seeing GDP growth in the black, but with a few exceptions. Tariff uncertainties are weighing on GDP in the US and select Asian markets, pushing GDP growth negative or in the red. Softness in Europe from late last year seems to have improved, perhaps related to the more dovish central bank. Sweden is the only country in Europe in the red right now. Latin America, namely Brazil, is also showing a modest lift in the growth rate from last year. Inflation is moderating in most countries, especially when compared to the peak levels in 2022. Some countries are now even below the 2% target rate, including the Eurozone, Canada, China, South Korea. Of course, there are a few countries going the opposite direction, perhaps signs of one of those feared secondary waves of inflation. The UK and Mexico fall into this category. Tariff policy seems to be a major uncertainty when thinking about future inflation. Will tariffs induce the feared secondary wave of inflation? Or will tariffs and tariff uncertainty induce deflationary economic weakness? Most likely outcome is probably somewhere in between. Indeed, the Fed is on record saying modest inflation and slower growth. Where does America stand now on tariffs? At present, our average tariff rate, right now it's about 14%. That's up from about 2.5% at the beginning of the year. Tariff rates will continue to escalate, likely headed to the 20 to 30% range by the end of the year. That will put us at a very elevated level, a level not seen since the Great Depression, as you can see in the chart here. We borrowed this slide from our deck a few months ago, mainly to use as a reminder that not all tariffs are the same. There are actually 3 categories of tariffs. In the left column, you can see the tariffs that are targeting countries that import a lot to the U.S., like China, Mexico, and Vietnam. These are the tariffs that are making the most headlines. In the middle column, we have the so-called reciprocal tariffs, which are aimed at countries like India and Brazil that have high tariffs on U.S. exports. Reciprocal tariffs are mainly symbolic since many of these countries do not export a lot to the U.S., especially compared to the countries in the first column. Finally, in the column at the right, we have tariffs on specific industries, the highest profile being the metals industries like steel and aluminum, but also most of the raw materials industries, lumber, agriculture, energy. Most of these tariffs create short-term distortions in pricing as producers and buyers attempt to front-run tariffs, but have less of an effect on long-term economics, especially when viewed at a global level. The impact of tariffs is not uniform across all stocks in the S&P 500. At the top left corner here, you can see that many industrials and consumer cyclicals and defensives will be raising prices straight away to offset tariff impact, actions that are being watched closely by the Federal Reserve and other central banks. These same sectors, plus technology companies, have generally altered guidance to reflect tariff impact as shown in the middle column. But operational footprints are most likely to change in the basic materials sector and healthcare. Looking at the bottom of the chart, in all 3 columns, you can see that some sectors are seeing very little impact from tariffs at all: financial services, real estate, utilities, and communication. So tariff impact is very much not uniform. The market has rallied back to nearly all-time highs since the announcement of the Liberation Day tariffs in early April. Much of that was driven by buy-the-dip behavior from retail investors. But the retail behavior was reinforced by a gradual easing of the tariff levels that were initially announced on Liberation Day. This has been getting extensive coverage in the financial media as pundits have labeled the move as the so-called taco trade, with taco being an acronym for Trump always chickens out. Taco. The chart here shows how every time Trump pauses a tariff and suggests a lower tariff rate for a particular country or industry, the market roars. Given there are hundreds of countries and industries and nearly all are candidates for tariffs lower than the Liberation Day tariffs, the taco trade could run for most of the year. The prediction markets are clearly tracking the stock market. As the stock market pulled back into a correction just before the Liberation Day tariffs, the prediction markets peaked, suggesting a 70% probability of recession before year end. But as the stock market bounced back amid buy-the-dip retail inflow and the taco trade narrative, the probability of recession dropped. It's now sitting at only 26%. Does this mean the prediction market is really not helpful at all? Well, prediction markets are only 1 to 2 years old right now and are fairly new in the US, so there is some learning happening for everybody. Perhaps in the future, though, the prediction market should really only be viewed when it differs meaningfully from the stock market. And of course, it always helps to look at surveys of economists from Bloomberg and elsewhere, and of course it helps to just do your own work. Consumer confidence is also tracking the stock market and the prediction market, but not quite as tightly. Consumer confidence dropped to near COVID levels in the first 4 months of the year, but it bounced back fairly strong in the month of May. If consumer confidence is indeed tracking the stock market, well, then we're likely to see a small but positive uplift for the month of June when that data is reported here in a few weeks. This chart looks at the Consumer Sentiment Index published by the University of Michigan, and it splits the index into responses by political affiliation. This data is through April, so it does not include the impact of the stock market bounce in May. As one might expect, Republican consumer sentiment runs high when there is a Republican president, and Democrat sentiment runs high when there is a Democrat president. But what might be surprising to many is the drama of the spread between Democrats and Republicans going back to 2017. One might expect a spread of 0 to 20 basis points given the laundry list of items that can impact consumer confidence: new technology, medical breakthroughs, foreign wars, pandemics. But instead, the spread is really wide, 40 to 60 points, and very persistent for the last 8 to 10 years. Perhaps the U.S. has become more polarized in the last decade or two. Secondly, the decline in consumer sentiment that has been closely tied to the stock market correction has been almost entirely due to Democrats. Indeed, as the stock market cratered, the Republican confidence actually increased. That's unprecedented during a stock market correction. The Trade Policy Uncertainty Index spiked to record levels amid the early April Liberation Day tariffs, but has since softened about halfway from the peak to where it was in mid-2024, where it was before any discussion of tariffs hit the news. The pullback seems to square with the chicken taco trade narrative that while tariff levels are spiking to the highest levels since the Great Depression, the tariff levels are lower than the sky-high levels that were announced on Liberation Day. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry discussion topics, as you can see listed here. Let's start by looking at the first one here in the world of biotechnology with a discussion on bispecific antibodies. Bispecific antibodies are a hot area in medical research these days. Most of the bispecific research is aimed at new medicines for cancer, though there are a handful of other applications for bispecifics, mainly in arthritis and other autoimmune disorders. This chart here shows bispecifics over the next 10 years are likely to be a nearly $200 billion market. This table is fairly detailed, but the top half is the list of most of the approved bispecific antibodies, and the bottom half is most of the late-stage pipeline of bispecific antibodies that are on the cusp of approval. 2 observations here. First, the top half table it's organized chronologically, and you can see the first approved bispecific was Blincyto, approved in 2014 for acute lymphocytic leukemia, ALL. 3 years later, we got Hemlibra for hemophilia. Then in 2021, the field exploded with 12 more entrants over the next 3 years, mostly aimed at cancer. And the pipeline in the bottom half of the table shows we're not done yet. Looking at the pipeline on the bottom half of the page, one other anomaly seems to show. The first 5 candidates are all in the same class of bispecific, combining VEGF with either PD-1 or its close cousin PD-L1. That ought to raise eyebrows. It appears there's a medical breakthrough here and a gold rush is upon us. Why the interest in bispecific antibodies for cancer research? Well, there's a handful of factors at play here. At the top of the list is that, well, we've seen good clinical results across a number of bispecific modalities as evidenced by the number of approved drugs and the size of the late-stage pipeline. Some tumors respond better to dual modality approach instead of the single modality of a monoclonal antibody. The dual modality of a bispecific also reduces the chance of drug resistance since you're not tapping out the same mode over and over again like a monoclonal. In theory, a patient could mimic the bispecific by taking two monoclonals, but that creates the risk of drug-drug interactions that don't really exist with an approved bispecific. Lastly, we've actually seen this movie before, combining more than one modality. With the antibody-drug conjugates at Seattle Genetics, those worked quite well, or even with the antidepressants, like the single-mode SSRI like Prozac, moving to a dual-mode SNRI like Cymbalta. There are risks out there. Bispecifics are more difficult to manufacture. I suspect that hurdle is not especially high, but it is a hurdle. Also, bispecifics have occasionally been criticized as being a limited scientific advance, since you're really just combining two existing monoclonal antibodies rather than inventing a completely new molecular entity. Fair criticism. Of course, though, that same criticism might be aimed at the HIV cocktails in the 1990s, but that cocktail approach resulted in a meaningful extension of life, so I'm inclined to look on the positive side here. We've had two gigantic biotech headlines in the last year, one positive and one negative. Last September, Summit Therapeutics announced its bispecific PD-1 VEGF drug, ivonescimab, beat Keytruda in a head-to-head phase 3 trial in lung cancer in China. You couldn't possibly have made a bolder headline. Keytruda is the world's largest selling drug with over $25 billion in revenue last year. While Keytruda is approved for multiple solid tumors, its first approval and most important indication is lung cancer. Every drug that has gone head-to-head against Keytruda has lost. Even drugs that are used in combination therapies inevitably show no incremental benefits since Keytruda is so effective. The news here was basically David beats Goliath. Summit stock quickly soared ahead nearly threefold. But fast forward to just 3 weeks ago, and the unpredictability of the biotech world manifested in a rather sharp setback. Seems as Summit expanded that phase 3 trial beyond China to include Western patients, the expanded phase 3 trial failed to beat its primary endpoint of overall survival. Fortunately, it passed its secondary endpoint of progression-free survival, so the trial was not a complete failure. But it sure tainted the miracle story from last year of David beats Goliath. Summit has multiple phase 3 trials ongoing. We'd be surprised if ivonescimab did not get an FDA approval in the next couple of years. It may not be the next Keytruda, but it seems likely to have a place in the oncologist toolkit. While the Summit news made headlines, there are 4 other bispecifics that combine VEGF with either PD-1 or its close cousin PD-L1, and all have signs of blockbuster potential. In particular, Big Pharma has stepped up with massive partnerships to the tune of over $20 billion. Clearly, Big Pharma sees potential here. These are large markets, and earlier stage clinical data, well, it's been fairly compelling. But not all stocks offer the same risk-reward for investors. The biotechs here are clearly the most concentrated plays, whereas the big pharma plays, well, they're fairly dilute. We tend to steer away from the big pharma plays since most have dozens of existing drugs, and the bispecifics, well, they're going to play a fairly inconsequential role in such a big portfolio. That's especially true for Merck in particular, since Merck is the one that owns Keytruda. Within the biotech space, Summit seems to offer a fairly balanced risk-reward, and still seems to offer a very high risk-reward, in fact, probably akin to a lottery ticket. But BioNTech seems to offer a fairly compelling risk-reward given its cash levels and pipeline. So let's take a little bit more of a look-see at BioNTech. BioNTech just entered into an $11 billion deal with Bristol Myers for joint development of its PD-L1 VEGF bispecific antibody, BNT327. The stock popped a bit on the news, though the announcement came one day after the news of the Summit debacle that hit all the bispecific stocks, a real buzzkill. But BNT327 is arguably the most compelling of the bispecifics given the late stage of the studies and the likelihood of the first mover advantage, the solid phase 2 data, and the largest investment yet from Big Pharma at $11 billion. Further, BioNTech seems to be a misunderstood company given its legacy from the COVID vaccines. BioNTech was, of course, the company behind the Pfizer vaccine for COVID, the first FDA-approved treatment for COVID. Of course, COVID revenue for BioNTech is now down over 90% from its peak, and it's effectively insignificant at this point. That said, the stock still reacts to vaccine news like Trump's RFK making changes to the vaccine approval requirements. BioNTech stock goes up and down based on that news flow. BioNTech has built up a solid war chest of nearly $15 billion in cash from its days in the sun as Pfizer's vaccine technology company. Yet the market valuation at present is only $25 billion, a little over 1.5 times cash. That seems to offer solid downside protection in the event that BNT 327 unexpectedly fails its ongoing Phase 3 trials. Also, BioNTech has a reasonably full pipeline beyond its high-profile bispecific. There are 3 additional cancer treatments in late-stage testing, including BNT 324, 111, and 323. And if the high-profile BNT 327 succeeds, upside could be significant. As a rule of thumb, for every $1 billion in peak sales potential, that adds about $5 billion in market value. While it seems unlikely to be better than the $25 billion of revenue from Keytruda, even a modest success with overall survival could drive BNT 327 to blockbuster status and drive shareholder value higher, perhaps much higher. Let's move on to our second industry topic, oil and geopolitics. Last week we saw the breakout of another hot war conflict with Iran and Israel as the two belligerents. The conflict immediately rippled through to the oil markets. Iran is a fairly big oil producer and exporter of oil, and the disruption to the shipping lanes is likely to impact production or exports from other Middle East countries. Middle East production is significant, but not as significant as it has been in the past. As you can see in the map here, the U.S. is actually one of the largest oil producers in the world, a change over the prior 20 years, mainly related to hydraulic fracturing or fracking technology. Oil prices over the last 25 years have always been subject to spikes and dips related to military conflicts. On the far right, you can see the oil popped from just over $60 a barrel to just under $80 per barrel with the outbreak of the Israel-Iran conflict in the last week. That's a similar level of reaction to the spike in October of last year with the Hamas attacks on Israel, and it's also similar to the lift of the Iran sanction fears in 2018. The reaction, however, is much smaller when compared to the lift in oil prices when Russia invaded Ukraine. And it is actually much smaller than the magnitude of the collapse in oil prices in 2014 when the US dollar strengthened after the Crimea invasion and the euro and the yen were proactively devalued. Will the Iran-Israel conflict drive crude prices even higher? Not likely, though the key here is whether the Strait of Hormuz stays open. We believe Hormuz is likely to stay open under pressure from other Persian Gulf neighbors, Kuwait, Qatar, United Arab Emirates, Saudi Arabia. Of course, there are other factors to look at when analyzing crude oil price movements. OPEC moves, stocking levels of refineries, Chinese demand, Ukraine escalation or de-escalation, also exogenous factors like hurricanes and earthquakes, and more. While oil stocks all popped higher on the Israel-Iran conflict, we're not really inclined to chase this move with increased positions in more oil stocks. However, we do like owning a small position in oil as a geopolitical hedge. Energy is a fairly small position in the S&P at only 3.3% weighting, so a small position in oil stocks can actually provide a decent insurance policy in the event of increased geopolitical tensions, especially in the Middle East. Not all oil stocks will behave as such hedges. However, essentially all of the 12 exploration and production oil stocks in the S&P 500 will qualify. In contrast, other energy companies in the oil value chain are likely to be less effective as hedges, so probably avoiding refiners, pipelines, offshore drillers, oil field services, and whatnot. We'd now like to move on to our third industry topic, AI and data security. But instead of listening to me chat about this topic, I'd like to hand the microphone over to our summer intern, Mercy Dada. Mercy's in his second internship with Cedar River. He worked with us last summer and is again working with us this summer. Mercy's entering his junior year at the Massachusetts Institute of Technology, where he's studying computer science. Last summer, Mercy helped us quite a bit with his analysis of the SaaS industry, or the software as a service industry. This year, Mercy's looking specifically at the AI and data security as a follow-up to the project on his work on the SaaS industry. So with that, I'm going to hand over the microphone to Mercy. Mercy, take it from here.
Thank you very much, Paul, for the introduction. To begin with, it's hard to discuss AI and data security without bringing up Palantir. The stock is up an amazing 20-fold in just the last 3 years. But why has the stock done so well? Palantir clearly has a compelling business model of refocusing military-grade anti-terrorist cyber threat software into new uses for business and government. Many believe Palantir is the best security service out there, especially in the uncertain new world of AI. Earnings growth has been exceptional and has actually accelerated from 20% in 2022 to 40% in 2025. But nearly 90% of the stock price gain has been due to a higher valuation. Only 10% of the move in the stock price has been due to higher earnings and cash flow. Palantir is now trading at 82 times sales, more than 20 times higher than the S&P 500 average of 3.5 times sales. So other technology disruptors may have better risk to reward setups at this point. The table here looks at just the 7 largest technology disruptors, most of which IPO'd in the last 5 years. Notably, the biggest 3, Palantir, Palo Alto Networks, and CrowdStrike, are all data security companies, one of the hottest fields recently. The remaining 4 are spread out in other areas in the cloud, including CoreWeave, focusing in AI hyperscaling, Snowflake in data access, Cloudflare in data migration, and Datadog in data analytics. Most have seen sizable gains since IPOs. Valuation for the disruptors are expensive. While Palantir seems to top the list of the most expensive, none of the large disruptors are cheap. This mainly reflects solid growth prospects for all. While absolute valuations seem prohibitive, relative valuations may play a role, especially without a bear market to reset valuation metrics. So some of these names have better risks to rewards than others and may see ongoing gains. Below are our summary thoughts on the 7 large cap disruptors. For each company, we give a 1 to 2 word description of what we think is the biggest headwind in red and the biggest tailwind in green. In light of the volatility and elevated valuation of these stocks, there is merit to using a basket approach to taking positions. We are inclined to stay away from the largest of these names. Palantir is just too expensive. Palo Alto Networks is a comparative bargain, but we worry about their growth by acquisition and the legacy of their on-premise business. On a relative basis, we are more drawn to CrowdStrike, CoreWeave, Snowflake, and Datadog. We are reluctant to name a favorite here, but in the next slide we'll take a look at Datadog a little closer. Datadog is a data analytics company, sometimes referring to itself as cloud monitoring as a service. This slide here is from the last investor presentation about a month ago showing the breadth of the product lineup. Datadog is not a pure AI play like say CoreWeave, but AI has been the biggest source of growth in the last year. Indeed, Datadog's largest customer is none other than OpenAI. AI native customers are now 8.5% of the annual recurring revenue, a figure that is likely to double over the next 12 months. Datadog could be fetching here and could prove quite interesting to look at. The stock gapped down hard in February on reduced guidance, but Datadog has a history of sandbagging guidance and beating them in later quarters. Indeed, in May, Datadog, quote, surprisingly beat expectations. And while the stock bounced back a bit, the bounce was not much of a lift compared to where it was at the start of the year. Valuation, of course, runs high at 12 times sales and 44 times EBITDA. The valuation is less expensive relative to its growth rate of about 30%, but compared to the peer disruptors, its valuation is the cheapest out there on sales and the second cheapest on EBITDA. Naturally, we would prefer to buy on a market pullback, but if the market continues to go higher, Datadog seems likely to participate.
Thank you, Mercy, for that discussion on AI and data security. Very insightful. Let's move on to our fourth industry topic, retail investors. Retail investors seem to be flooding into the stock market at unprecedented levels. Indeed, retail investor market share hit an all-time high of 36% in late April. Why are individual investors opening those do-it-yourself brokerage accounts and trading the stocks all by themselves? What happened to that passive ETF stealing market share from all active strategies? A handful of factors are driving investors into the market for individual stocks. As you can see on the chart, the lift started actually with the COVID during the quarantine and work from home days. The onset of COVID was actually nearly coincidental with the launch of zero commission trading at the brokerages. Add to this the increasing ubiquity of sports gambling like DraftKings, which also IPO'd through a SPAC in 2020. Hollywood seemed to recognize and embrace the culture of retail investors with the Dumb Money movie that highlighted meme investing in the GameStop situation. Robinhood Brokerage drew more small investors with the gamification of investing and offering free stock for new accounts. Some have suggested that the draw to stock trading, as well as sports betting, is a sign that today's youth is discouraged with underemployment and the inability to get ahead. Also, while the flood of buy-the-dip investors was dominated by retail investors, it's hard to be critical of the retail crowd. Buy-the-dip has been a good strategy. If retail investors are coming to dominate stock trading, this begs the question, what types of stocks do retail investors buy? Of course, most public stocks disclose what portion of their ownership is retail versus institutional investors. But at a broad level, retail investors buy names that they're familiar with, just like grocery shoppers at a statistical level prefer buying the familiar can of Coke rather than the unfamiliar Brand X soda. And as Coke can tell you, this means brand awareness, and brand awareness is generated by maximizing consumer impressions. Of course, consumer impressions are a little different for a stock than for a consumer product. Indeed, there are two main sources of consumer impressions for stocks. On the left, we have stocks with names that are tied to consumer brands like Apple, Amazon, Costco, McDonald's. These names are all disproportionately owned by retail investors. On the right, we have the other source of consumer impressions for stocks, when a stock is incessantly in the financial news, especially related to overvaluation controversies. Almost all of these names are regarded as story stocks, and story stocks are disproportionately owned by small fry retail investors. Tesla's right at the top of the list, where it generates virtually none of its consumer brand strength through traditional advertising, but has immense consumer recognition thanks to jillions of consumer impressions generated from the financial media. Tesla's heavily owned by retail investors. Other story stocks that are heavily owned by retail investors are Palantir, Bitcoin, Nvidia, most high-profile IPOs like CoreWeave, and others. Why do consumer impressions matter for retail investors but less so for institutional investors? Well, the main difference is the decision-making methodology. Consumer impressions play a huge role in impulse decisions like buying that can of Coke, but they play virtually no role in evaluated purchases like buying a new refinery or a new nuclear power plant. Institutional investors may not have the option to make impulse purchases given fiduciary duties and reporting to internal committees of experts. This means that stocks with high retail ownership are stocks with high consumer impressions, either through advertising or through incessant story stock coverage in the financial media. Graybeard investors might wonder about retail participation in high beta story stocks when historically retail stocks were usually just the opposite, low beta dividend stocks like utilities and REITs and master limited partnerships. These dividend sectors still have retail ownership, but a less active subset of retail investors. Also, many of the pure retail income sectors have acquired institutional ownership over the last 20 years via dividend fund vehicles that pass through tax benefits. It's a changing landscape for retail investors. Where does retail not play a role? Well, midstream manufacturing is high on that list. Also, not many non-oil raw materials, so companies like specialty chemicals, lumber corporations, packaging companies, agricultural processing, and many more. If it's boring and you've never heard of it, then it will be owned by institutions, not retail. Lastly, the retail buy-the-dip rally in the last month may set the stage for future buy-the-dip rallies. The persistence of the retail dip buyer seems quite notable. We're now going to move on to our last topic, weak dollar tailwinds. This is the same chart of the US dollar that we showed back on slide 16, showing the US dollar was at a 3-year low. Usually a decline in the US dollar means the Fed is cutting rates faster than other central banks, and such sell-offs are usually temporary as most central banks seem to be in coordination in the last few years. But this sell-off is unusual, and it's almost entirely due to trade policies and the perceived increased risk of the US dollar. Does this mean we are likely to see a flip back to the 2004-2013 weak dollar theme when oil stocks and non-US BRIC stocks led the market and technology and consumer stocks lagged? With the softness in the US dollar this year, the question then becomes, has the dollar declined enough to be regarded as, quote, weak? We do not believe so at this point, but perhaps another 10% weakening from here might start to move the needle. Of course, while the dollar may not be weak officially, it is weakening, and that is a huge tailwind to non-US stocks. The trade-weighted US dollar index is running just below 100. Right now it's at 98.5. During the 2004 to 2013 era of strong oil and strong non-US BRIC stocks, the trade-weighted dollar was running much lower in the upper 70s. Most of the post-Crimea era, when big tech led the market, the trade-weighted dollar was in the 90s pre-COVID and in the low 100s post-COVID. We've only weakened into the upper 90s, but if we break below 90, that will likely set up a scenario where global raw materials will see elevated pricing, and that will likely be led by oil. We've used this slide many times over the last decade. What sectors go up when the US dollar goes down? Conventional wisdom is that U.S. exporters like Boeing will be able to sell planes cheaper than Airbus, which has an overvalued euro. There is some merit to that explanation, though the Boeing supply chain is global and subject to import tariffs, so the cost of making planes may not be so tightly tied to the currency. The broader but less conventional outlook is that a weaker dollar lifts global raw materials prices. That's why oil prices lifted from $20 a barrel in 2003 to over $150 a barrel in 2008. It was a weak dollar. Same story for other global raw materials, including most metals and grains. Lastly, most foreign stocks do well when the US dollar is weak or weakening. Will another weak dollar era see the same winners and losers as the last one? No, but there will be similarities and differences. Foreign stocks will see inflows. The main difference today, though, versus 2004 is back then China and Russia were our friends, and both experienced sizable inflows into their capital markets amid US dollar weakness. Today, a weak dollar era would not bring money into Russia or China. Maybe Brazil, maybe India. But so far, with the weakening US dollar, one of the biggest beneficiaries has been Europe, with the euro lifting above 115 against the US dollar, and the euro stocks index up over 26% in 2025 so far. There's also sectoral differences, one of the big ones being that the U.S. is a net oil exporter today versus a net oil importer in the prior era. So the weak dollar will not weigh on the trade deficit due to higher oil imports, a self-reinforcing crisis back in 2004 through 2008. Also, we did not have a tariff war in 2004 through 2013, and today's tariffs on select metals like steel and aluminum is likely to add noise to trading behavior and short-term commodity prices. Before we conclude, we have one additional slide about how the stock market rises and falls over the long term. The stock market generally trends higher over time, but there is much variation from year to year. This chart looks at the stock market returns by year between 1872 and 2024. As you can see in the box on the left, the median return is 9.6% over that 152-year period, but the standard deviation is quite wide at 18.2%. Also, you can see positive years in green are more common than negative years in red. Up years are actually more than twice as common as down years. The read here is that the stock market indeed trends higher over time, but with short-term year-to-year variance on the way up. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.